Okay, well, welcome everybody to this Fintech for Good webinar. My name is Paul Miller and I'm CEO at Bethnal Green Ventures. For those of you who haven't come across Bethnal Green Ventures before, we're a leading tech for good VC firm investing in early stage businesses that aim to have a positive social and environmental impact across sustainable planet, healthy lives and a better society. We've invested in well over 100 companies now. And I guess one thing that we've seen over the last few years is a growth in interest in what we're terming today fintech for good. So businesses that are solving problems around financial exclusion or difficult to reach groups when it comes to financial services, and really, in some cases, really trying to tackle inequalities, economic inequalities. So we're really interested in this topic. We think it's super fascinating, and we hope to be making more investments in this area. We're delighted to partner up with Big Society Capital, who are one of our limited partners at BGV, to run this webinar, and you'll hear from Camilla in a moment as well. But yeah, really great to have you all here. Please do reach out to us at Bethnal Green Ventures if you want to find out a little bit more about what we do afterwards. I'm just Paul at bethnalgreenventures.com, or we're at bethnalgreenventures.com on the web. And it's my pleasure to hand over to our chairman at BGV, Giles Andrews, who's got a long and illustrious history in fintech. He was one of the co-founders of Zopa, and is a non-executive director of a number of fintech businesses, and as well as his role as chairman of the board at Bethnal Green Ventures. So Giles, thanks so much for joining us, and I'll hand over to you to introduce our panel.
Thanks very much, Paul. Very good to be here. I'm delighted to host this webinar. It's a subject near and dear to my heart. If I sort of reflect back on Zopa, when we founded the business, we were arguably one of the first fintech businesses, and we always believed in doing the right thing and therefore being a force for good. I think in our case, though, so my interpretation of fintech for good from that experience is that we use technology to enable a better service in financial services and provide better value, and therefore we're a force for good. But we weren't necessarily successful in broadening the market reach or the market that we served, and despite our best endeavors to do so. And I think therein lies a challenge, which I'm sure we'll explore in the theme of this panel. But before I sort of move into questioning, I'd love to introduce my fellow panelists. So Camilla from Big Society Capital, might say a few words.
Yes, thank you, Giles, and good afternoon, everyone. It's great to be here. I'm Camilla Park. I'm an investment director at Big Society Capital. We are a wholesale social impact investor. So our job is really to build an investment ecosystem that connects capital to social purpose organisations that improve people's lives in the UK. And we've invested in close to 90 fund managers, including BGV. We've been working with BGV since 2016. We've catalysed close to £1.4 billion worth of capital from other investors alongside us. Venture's a core part of our portfolio, and fintech for good, a core part of that as well. So really excited to have this conversation and to be here today.
Thanks, Camilla, and thanks very much for your support at Bethnal Green. Very gratefully received. Miriam Freeman.
Hello, everyone. Good morning, good afternoon. I'm based in Washington, D.C., so morning for me here. It's great to be here. I'm with JP Morgan Chase. I sit on our global philanthropy team in the foundation. So as you know, JP Morgan Chase is quite a complex organization, but we manage the grant side of the funding portfolio, as well as complementary other financial tools. And I'm on the financial health team, which is one of the 4 focus areas of our work throughout our corporate responsibility initiatives, all leading to economic opportunity and growth. And we do work where JP Morgan Chase has presence across the world, so a large focus in the US, as well as in both emerging and developed markets around the world. and looking forward to speaking more about our fintech portfolio. We have the Financial Solutions Lab, which focuses on fintech and financial health in the US. We also have the Financial Inclusion Lab in India and the Catalyst Fund in emerging markets, Africa, India, and Mexico, as well as some exploratory work in Europe and the UK in particular with the Resolution Foundation, which Louise will speak to more later.
Louise?
So I'm Louise Marston. I'm Director of Ventures at the Resolution Foundation, which is an independent think tank focused on improving the lives of those from low to middle incomes in the UK. I've joined last year to lead our social investment work, which is at the moment focused on worker tech, an area where we've partnered with Bethnal Green Ventures. We're just starting to get our first cohort of those through at the moment, which is really exciting. And we've been working for about the last year with JP Chase Foundation on examining financial resilience in the UK, France and Germany, and looking at the areas in which innovation might support that.
Thanks, Louise. Omid.
I'm Ommeed Sathe, and I run Prudential's impact investing activity. This is the US Prudential, so obviously there's two of them out there. And financial inclusion has been a major theme within that portfolio. It's about $1 billion portfolio at the moment. We invest exclusively sort of in private investments, and it's about 25% of what we do is in emerging markets, but the rest primarily focused on the US. And so we've invested both directly as well as through fund managers in a range of different financial inclusion strategies.
Great, thanks. Well, let's kick it off. And as I said, by way of introduction, Fintech for Good is a topic close to my heart, and something that I had huge aspirations for in developing Zopa. The investment landscape when we started the business back in 2005 was made up of, dare I say, more conventional venture capitalists who were making a financial investment in the company. Had to be comfortable with our emphasis on doing the right thing, but were financial investors. So I think some things have changed. But let me ask the panelists what Fintech for Good means for them. I mean, for example, does it mean using technology to deliver better outcomes, or is it a more fundamentally different way of doing things, in which case often applies to early adopters more than mainstream, or is it about serving different markets, such as potentially emerging markets overseas or the underserved closer to home? Let me start with you, Miriam. What do you think on the subject of what is Fintech for Good?
Yeah, thanks, Giles. I love this question, and I love sort of the personal experience you brought to it, because I think it's wonderful for corporates of all sizes and stages to have the best of intentions in terms of coming at it from a good perspective. But for us, it really comes down to intentionality, which I think is something we hear a lot in the impact investing world. So it's necessary but not sufficient to have good intentions, if you will. And it really, especially when you look at fintech, you have to think about the whole stage of the process in order to be able to reach folks who have, for a lot of historical reasons, and those are different in different geographies, been sometimes intentionally and sometimes unintentionally excluded from financial systems. And so they're not going to be included unless there's an intentional effort for that to happen. And so that starts with the design and the founder of a company. It helps if the folks who are starting the initiative are from the community that they're hoping to serve, or at least building out a team that is close to that community and is familiar intimately with the challenges that they're facing. And then it continues on through product design, through user testing, through incorporating that customer voice in every stage of the product development. In terms of marketing, that's responsive and appropriate to the folks that the product is targeting. And then it goes all the way through. I think perhaps the most important piece for us comes down to the measurement. So there's all these sayings about how ultimately what a company is doing is going to be driven by what it's measuring. And so if those business KPIs are different from the social KPIs that it's seeking to achieve throughout its development, then that's going to create an inherent tension, which I think you've alluded to in terms of some of the investments. So having those be aligned as much as possible is truly what's going to drive fintech for good in a sustainable way, and is going to prevent companies, especially as they grow, from being pushed upstream up market to serve folks who already have the benefit of access to the mainstream financial system. So if you think about some of the financial health outcomes, like savings is an easy one. Having a savings metric that's part of what drives your business, as well as what drives financial health outcomes for your customers, is really important to integrating those two pieces of the puzzle.
Interesting, thanks very much. Any other thoughts? Does fintech good for good mean anything different to anyone else?
So
I think I would say is I think
agree on the outcome side with Miriam. It's really important that the outcomes are part of the process, whether that's a commercial or a social venture, and that's what's being measured and targeted, and that's what's being managed towards. But it also is going to depend hugely on the geography, as Miriam alluded to. What underserved means, what the set of issues are, varies really considerably by country, and by the existing system that's in place, who's excluded from that, what the historic issues are. So it can mean a lot of different audiences.
Omid, you tried to jump in then.
Yeah, I was just going to point out, I do think one of the tensions that everyone's highlighting is that, one of the easier things to measure for any sort of intervention is scale and access, the number of people you're serving. Whereas like the nature of financial services is that they are entirely about suitability, right? There's no financial services product that's an unmitigated good. And there might be some that are unmitigated bad, but most of the time it's sort of, is it the appropriate tool at the appropriate time? And so there's a nuance inevitably built into this work. And I think that's really tricky because measuring quality is much harder than measuring access. And so I think where you've seen problems is where exclusive reliance on measures of access take precedence over measures of quality. And so if you think about sort of microfinance as a great example of that, for a long time, the two were, I think, quite intimately intertwined. And then you sort of had almost a growth phase where people were looking at just the scale of lending as the primary sort of measure of quality. And of course, then you sort of had all of the incentives, just like in the US subprime crisis, to overextend. And so I think that's always the subtlety with financial services that makes it in a lot of ways very different than a lot of other sectors around impacts of food or water access, where generally speaking, measuring simply the volume of customers served is a really good proxy for your outcomes. So I think that's one of the key nuances.
I think that's a really interesting point. It's very hard to argue that you can dig too many wells or supply too much water, but providing money to the wrong people on the wrong terms can have hugely damaging effects. And we've talked a bit about the underserved. I mean, what do you think I'm going to ask this question to Louise. What do you think the challenges are in reaching the underserved? And are there enough of them? Are there clearly enough people, but is there a large enough addressable market to build an investable business? Because investors do look for a financial return as well as a social return.
Yeah, absolutely. So I'm going to speak particularly to the UK, but there are obviously different issues when we talk about global reach on some of these things. In the UK, financial resilience and financial health is quite a large problem. It affects a really significant number of people. So we're not just talking about unbanked people who are unable to access a bank account, although there's still a small minority, and that's still a significant problem. It's a smaller problem than it used to be. But we're talking about, the 11.5 million people with less than £100 in savings to fall back on, and that was pre-pandemic. We're talking about people who are unable to cover 3 months where their income's dropped by 25%, something that's happened to a huge number of people over the course of this year. We're talking about lots of use of credit, even at quite kind of middle to high income levels, lots of people living beyond their means month to month. So it's not a problem just of people who do not have enough money, which is a significant problem, but it's different from, I've got lots of income, but I've also got lots of debts to service. Or I've got plenty of income, but it comes in really unevenly because I'm either self-employed or I'm doing multiple jobs. And so matching my outgoings to my incomings is very difficult, makes it budgeting harder. So there's quite a lot of subgroups when we talk about underserved groups in the UK. And so that means that there's multiple different markets to think about. And some of those are characterized by relatively novel things, so atypical employment, anything that's sort of characterized by irregular wages, self-employment, 0 hours contracts, those kind of things, has been growing really rapidly from sort of between the financial crisis and pre-pandemic. zero hours contracts grew by 5 times in that period of time. So there's some novel features of how people get paid and how they spend money that mean that the financial services system hasn't caught up really in most cases, and still operates in some places in very traditional lines. But there's also a big group of people who just struggle to manage their money and struggle to have enough income kind of month to month. And sometimes that can be a space where you can help people out, but sometimes that's just a case where really policy and philanthropy needs to step in, because the incomes aren't high enough really to be able to do anything new and interesting. It really is just a fundamental matter of not enough income. So it's quite a variety of different needs when you look at the UK in particular. And then I'll let others speak to what that looks like in other countries.
But we couldn't be having this conversation at a better time. And I think what I'm hearing in a way is that all sorts of previously mainstream customers who have bank accounts, who have relationships with financial services providers are now underserved because there isn't an appropriate service for them given their changing circumstances. Omid, would you like to come in there?
So I think it's interesting to compare some different niches of financial services. So for example, payments is something we've invested pretty heavily in. And I think that's a really good case for FinTech for Good, where you're able to sort of squeeze out what have historically been incredibly high friction, high fee interactions. So whether that's digital remittances, or where you see sort of in various emerging markets, efforts to sort of distribute benefits electronically as opposed to more sort of corruption-laden and friction-filled sort of interactions. So I think on sort of the core rails, if you will, of payments, has been an area that's been pretty interesting, especially in the emerging markets in terms of reducing costs to low-income families. With remittances, I think being a really interesting one in the pandemic case, and we've invested in a company that's sort of doing exclusively digital remittances and bringing down those costs of sort of money transfer. So I think that's a huge opportunity set just to eliminate friction, and you see that even in sort of getting money to remote places. I think another sort of really interesting thing that we've seen happening is around sort of micro payments for essentially installment purchasing. And so one of the more interesting cases we've seen is with off-grid solar in sort of very rural parts of emerging markets. The niche that was so interesting was that solar power in those settings is actually cheaper than kerosene if you take sort of the extended cost over any reasonable time frame. But there was never any way to do sort of installment payments before you sort of had mobile money and some of those things. So I think micro installment payments and those sort of are some of the more interesting use cases. Whereas I do think to Louise's point, some of the savings challenges are not really FinTech solvable, because it's at least the business models for savings right now, there's no margin to be generated. There's no sort of use case for the customer. It is inefficient to provide a $100 bank account with all the regulatory overhead in the developing world. And it's not clear that's going to be the thing that gets people to save anymore anyway. So I do think there's a real nuance in terms of there's some problems that are lend themselves to FinTech and others that I don't think are technology problems.
Thank you very much. Miriam, go ahead.
I could just be controversial for a moment.
Without that.
I think that we actually see very exciting opportunities that move beyond some of the transaction and payment rails, which had been so exciting in the past few years, but that do get into some of those more holistic financial health outcomes like savings, which have been tricky from a business model perspective. But as we have some of that infrastructure collectively in place, it actually becomes a bit easier, and that there's a bit more room for creativity. So we are seeing companies, they're early stage, and so there's still a lot of open questions. But I think it has actually been exciting to see some of those innovations that are taking the collective landscape to the next level, and being able to integrate some of those services so that they're offering consumers not just a way to transfer money, but a way to also accumulate savings and build a cushion that they can draw on when they have those difficult moments that Louise referred to.
Moving on. A question I had was, there's a very well-established financial services sector. I mean, there are enormously varied and huge companies providing a myriad of services. Why can't the financial services sector be doing it themselves? Why do we need a new movement called FinTech for Good? Or if unable, I'd be interested in people's thoughts as to whether they can or can't do it for themselves. And if they can't, should they be investing in startups? In other words, should the existing players be investing in startups, or should it be new fund managers or new investors? I'm going to start with Omid on that one.
Great question. I do think, and it's very hard, especially for some of your established financial services players, to shift their business models to what is really a different paradigm, right? I mean, low cost distribution, high volume, small margins, as opposed to, quite frankly, most of the big financial services names have made their money on high margin products to large clients, right? And so it's a different architecture right from the get-go, which is why I think you've seen a lot of the traditional financial services players struggle. I do think whether it's JP Morgan or Goldman Sachs, I do think you see some of them really trying to think more creatively about how to stretch their business models down. But I do think it's, I'll give an example from our portfolio. One of the things that's made cross-border sort of small dollar remittances very difficult has been that the entire architecture around sort of know your customer, right, is structured in such a way that the punishments from getting it wrong, if you're a large institution, are so much worse than any amount of revenue you could make from serving very small customers. And so the regulatory system just keeps you out of that market. Now, smaller entities that have less sort of regulatory exposure can enter those things and do it profitably. But sometimes there are those sort of regulatory cliffs, if you will, where below a certain point, it just becomes cost ineffective. But I think more of it is a cultural and a business model innovation issue. So I do think if we're looking to do it quickly, investing in specialists has been a big part of it. We've certainly done that in our portfolio. And I actually think the interesting thing we've seen is that the innovations that we're seeing in emerging markets in particular are actually in some ways light years ahead of what we're seeing in developed markets. That because people are being forced to sort of have to serve customers on incredibly small margins, they're finding really creative ways to sort of do things in an even more cost-effective manner. So we've seen some interesting opportunities to almost reverse import business model design.
I mean, you can take, I suppose, an example of mobile money is a good one there. In an environment with no real financial services infrastructure, no online banking, the rise of M-Pesa initially in Kenya and then obviously more widespread is remarkable and an example of that cliche leapfrog technology. Are there any other, Louise, any examples of differences between countries that you could highlight?
Yeah, so we've been looking at the landscape of these kind of issues in the UK and comparing with France and Germany, and the banking sectors in each of those three countries are very, very different. The landscape of existing financial institutions and what their remits are is very different. And in the UK, we have a relatively small number of very large institutions where the majority of people do their banking. And we've got some of the classic problems of innovation, which is when you've got a large institution that's existed for a long time and has a bunch of existing systems and processes, it's really hard to do new things. So there's the cost barriers that Omid was referring to in terms of trying things out, but there's also, there's cultural inertia, there's just the difficulty of adding new services onto that existing model. But it's interesting that in France, in particular, where we've been looking at this, there's less activity overall, but actually what there is coming out of the existing institutions in a lot of cases. And that's partly because some of the banking system already has a remit to have public benefit. So the Banque Postale and some of the credit mutuals and so forth, there's already a larger landscape of financial institutions with some objective of supporting public benefit, which isn't really existent in any large scale in the UK. It's a very small sector. And they've been starting to generate ideas. And we've also seen that there are some of the mainstream banks in France, either through acquisition or through generating ideas, have started to add additional services for low-income accounts and so forth. So the landscape of existing institutions and regulation does make a difference as to whether this is something that's easy or feasible for large companies to do.
Great. I mean, you're all either directly involved in making investments yourselves into specific entities or investing in funds. So wearing your sort of portfolio hats, where do you see fintech for good as a subset in terms of related to your broader investment mandate? Is it a thing that you allocate a proportion of your assets to, or is it more opportunistic? Let me start with Camilla.
Thanks, Giles. Yeah, so I mean, venture is a core part of our sort of investment strategy overall. And I guess the exciting thing for us about sort of fintech for good within that is really the potential to have sort of transformational impact, social impact on people's lives. And I think it touches on a lot of things we discussed around fundamentally delivering products and services that meet people's needs better. Now, the extent to which the sort of technology aspect of that, it enables scale, enables us to reach some of those underserved consumers. I think for us, that's really exciting. And also the sort of intersection with different sort of social outcomes. So we touched on that link between financial inclusion, financial health and resilience, and sort of general mental health and well-being. So for us, when we think about some of the social issues that we're trying to address, income, financial inclusion, even broader health and well-being, addressing, using kind of fintech for good as a tool, one tool to deliver those kind of positive sort of social impacts is sort of really, really key for us. And those ventures sort of appear in a number of the different funds that we invest in, and they sort of sit broadly across the sort of venture ecosystem and landscape. So we're able to work with accelerators like yourselves that are really fundamentally important to those ventures at the early stages in their lives, through to investing in sort of later stage funds, where we're looking for managers that really have that potential to that potential to help those ventures to scale and reach those sort of different pockets of underserved sort of consumers. So for us, it's a critical tool to achieve the impact that we're looking to achieve across our portfolio.
Thank you. Any other thoughts on the portfolio makeup?
Yeah, I can just also add, similarly, we have fintech innovation as one of the focus areas within our financial health approach. But it's a very interesting trend that we're seeing within the accelerator work that we fund, in particular the Catalyst Fund, which works in emerging markets, is this move towards embedded finance, which Omid alluded to as well. In terms of PayGo, for example, the Catalyst Fund just announced yesterday its latest cohort, and all of the companies that are focused ultimately on the financial health of low-income consumers in emerging markets are doing so in a way that's embedded in other business models. So it's providing access to a savings product or to insurance or to some other financial product via another business or another employer, or through another way that folks are needing to access those services in their daily lives. That's not as simple as I need to open a bank account to do X, Y, or Z. So I think that that's something that we're seeing across the board, and that it will continue, we believe, to move in that direction unless be sort of a one-off financial transaction and more integrated into the other types of services that people are using on a daily basis.
Great. Well, I'm keen to involve the audience as much as I can, and I've seen a question from Felicity Jones. Thank you, Felicity. And if anyone else has questions, please fire them at us. But I'll fire this broadly, and if one of the panelists can sort of go on mute, I'll know who wants to answer it. But how can and do fintech for good investors identify and connect with NGOs and social enterprises who are delivering on the ground, e.g. VSLAs for Africa, for women in Africa? Any thoughts on that? NGOs in Africa? How can fintech for good investors? So in other words, I think that's saying that if people do want to invest in the sector, how do they find out? Another way of asking the question is, how do they find out which NGOs and social enterprises are doing a great job? Is there a sort of classification system that anyone can have access to?
Maybe I'll critique sort of one of the challenges is that, if you look at someone like ourselves, right, or that sounds like Camilla as well, we're allocating to managers who are then sort of allocating on the ground. And I would say it's been striking to me in our portfolio how much of there is a groupthink mentality. I mean, if you look at the entrepreneurs and the companies that are getting backed in Africa, it's surprising and shocking to me actually as an investor how often the same name shows up in multiple fund managers' portfolios. And one would think, given sort of the variety of potential opportunities, that you'd be very unlikely to see that happen. And yet there is, I think, in a weird sort of way, well, not in a weird sort of way, I think in part because emerging markets are perceived as risky, people tend to be going to companies and founders that are coming from very traditional networks. So the background, the education, the pedigrees, and so I think it's I'm certainly of the viewpoint that we must be missing other opportunities on the ground that are not part of those networks.
There's sadly often not always a positive correlation between those who are good at raising money. Yeah. And those who will do good with it. I think that's a common theme. Any other thoughts on how investors can interact? I think the question is aimed more at the developing world.
Just picking up on Omid's point, this isn't an exact response to the question. I think that's true. And I think it also speaks to the need for investment broadly. So, from philanthropy, from all pieces of the capital spectrum in very early stage companies and nonprofits, frankly, that are developing some of these innovative ideas in the fintech for good space, where they don't have access to the networks and the resources and the Y Combinators of the world necessarily. And that's some of the gap that we're trying to fill with some of our early stage accelerator programs that we fund. But there's absolutely more room, and would welcome more players in that space as well.
Thank you. So move on to another question. I mean, when we look at, I hate the use of the word ecosystem, but people seem to use it a lot. But if we look at the fintech for good ecosystem, what's missing? Is it capital? Is it money? Forgive me, my phone is ringing. I have to kill it. Is it capital missing, or investment opportunities, broadly speaking?
I can start on that, at least from the UK point of view. So I think there are multiple missing pieces at the moment. I think there's something I've been trying to work hard on, trying to identify where the gaps are. There's quite a few. I think there's in the UK and in several other countries, we've got a very thriving fintech sector. We've got a thriving social enterprise sector. We've got quite a lot of charities, NGOs, and in some cases sort of government bodies or public bodies that have some of these issues at their heart. But there isn't a huge amount of connection between them. And there's, I think, a lot more to be done to join up those perspectives and make sure that the expertise and the knowledge about the way that you can use the structures that Omid was referring to earlier in terms of the cost benefits and the ways to make things more efficient could be joined up with some of the issues on the ground. So I think there's some connecting pieces, but there's definitely also some capital gaps, as there are in other areas of social enterprise and tech for good.
Just to agree, Louise, there, I think that point around connecting different parts of the already strong sort of ecosystem, for whatever better word, is really, really key. I think for us, one of the roles that we see, Big Society Capital sort of potentially playing is particularly around sort of tilting that's the strong sort of existing players in space that we have towards greater impact and sort of helping, collectively improve the tools that we have to help some of those ventures articulate their impact thesis, and then really critically, as we touched on earlier, how to sort of measure that. And there's all kinds of benefits of setting out to sort of measure impact in a really robust way. It helps understand whether we're meeting those needs of users in a more sort of effective way. It ties customers and consumers into the products in the sort of longer term. So I think for us, that sort of piece of connecting all the parts together is really, really critical. And whatever we can do to sort of support ventures themselves in building impact into their sort of thesis and building it into the fundamentals of their ventures from day dot is really important there. And I think for us, it's connecting investors, demonstrating how these businesses do have potential to scale, generate positive difference in people's lives, and the role that they can play in a sort of diversified portfolio. I think all of those things are really building on the opportunity, the strength that's already there, sort of in the system.
I might just have one thing, is that I think there's a very particular kind of capital that's missing. I mean, I think the world is clearly awash in capital writ large, but it's what I would sort of describe as catalytic or flexible capital. that if you think about what doesn't get done by sort of the venture community, but still kind of makes some sense, there's a lot of sort of early stage risk taking, ecosystem building, as you said, connecting people. But right now, all of that work's exclusively being done by sort of government or philanthropic resources, and not being done with sort of an ability to recapture some of those investments as investments. And so I think, if there was a way to sort of couple the ambitions of sort of the philanthropic and government sector with the process of the private sector in terms of being able to go fast, go quickly, take bets. I mean, it's, we work pretty closely with our foundation, and it's been shocking to me, if an investment goes south, that's just investing. Sometimes things don't work. What's the average return? On the philanthropic side, if a partner goes bust, there's like a year-long, after action review wondering why, and it's baffling to me that actually a grant-making tool is having less volatility in their outcomes. And so I think it's interesting to think about sort of how do you bring sort of the venture mentality that, one good bet pays for 10 misses to more mission-oriented capital, and particularly that ability to work at the speed of business as opposed to the speed of philanthropy.
So you're highlighting a sort of difference in risk appetite, philosophically speaking. Louise, you wanted to come in here. I think Louise is frozen. So actually, Miriam, you were going to jump in as well.
Yeah, just a quick follow-on point. Completely agree with that need for more on the capital continuum, and that's something that we've been pushing on, particularly within our work at JPMorgan Chase. So, in addition to our grant making, which has been the fundamental tool within our foundation, we've actually been exploring. Last year, we have started using concessionary debt as a tool, and are continuing to sort of push the envelope on other ways to structure capital that falls between grants and our more traditional investments within the investment side of the house as well.
Thank you. We've lost, Louise was desperately trying to make a point and we managed to lose her on the way, but hopefully she'll come back. But I've got a question here from Rob Love, the CEO and founder of Crowdfunder UK, and he raised an interesting question around whether or not the sort of status of the company is relevant when people are making investments. So as a limited company, he says he struggled to raise investment from people as a social enterprise. And therefore, do panelists worry about the B Corp or not-for-profit status of entities you're investing in, or are limited companies fine? Who wants to start with that? Louise is back, but I suspect might have missed the question. Can anyone answer Rob's question, whether you're sort of agnostic as to the status of his company, or whether it needs to be registered as a social enterprise? I mean, I can speak for BGV, which is that we're happy to invest in companies. Paul will jump in and correct me if I'm wrong, but I'm surprised that you say that that's a barrier. And being an intermediary, if you're, Bethnal Green Ventures is an intermediary. It takes investors' money. The same way Big Society Capital is an intermediary. I don't see that being a barrier, but perhaps you can speak to
how we're approaching social investment. I mean, certainly sometimes it's easier where companies are incorporated as a company because you can take shares. It doesn't mean you can't have social purpose, and there are any number of mechanisms for doing that. And I know a number of other social investment bodies in the UK take a similar view to that. But
so you think it's actually helpful for companies to be limited?
In some cases, it depends exactly how the funding is structured. But certainly there's no barrier to charities and foundations investing in companies. They need some alignment on social purpose, but that isn't prescribed. Yeah, I think in some cases it's helpful, but there are an increasing number of mechanisms that will help with CICs and other forms. But in most cases, a company on its own isn't a problem.
Great. And I think you wanted to make a point about what was missing from the ecosystem.
Yeah, I mean, there's the very kind of instrumental things around capital and connections and things, but something else that's sort of less tangible is the role of lived experience in this. We talked at the start of this session about intentionality, and that having good intentions wasn't enough. And I think you sometimes see initiatives in this space which have very good intentions, but don't have a really good grasp of what the issues are and what the real barriers are to making an impact on people's financial health. And you can very easily see things that are aimed at people like me, when the median income in the UK is below £30,000 a year, and vast numbers of people don't have 100 quid in savings just to ride out a week's gap in their incomes. So I think there is sometimes a gap between an idea of what the problem might be and the evidence-based reality of what actually solves those problems. We referred very briefly earlier to the issue with things like savings, that just creating a savings account for people that they can access doesn't necessarily solve the problem of building up a savings pot. Lots of those issues are around behaviours, around whether it's better to prioritise saving money as opposed to paying off debt. There's some complicated issues there, and sources of really good information on that, which include the charities, the sort of debt advice charities, and connecting those into people developing these ideas is a really important thing to do. And something that in the UK we have Fair for All Finance, which is a relatively recently created body which has dormant account money coming from the UK government, sort of directed, which is joining up some of those pieces and providing a bit of that catalytic money. And I think that's an interesting space to watch as they aim to support more new product stuff and more innovation within existing institutions as well, and targeting that at the most vulnerable.
Thanks, Louise. I've got a question from Crispin Kenny. Thank you, Crispin. How do you see the future of measuring impact improving going forward? And what do you see as the greatest limitations at the moment with measurement, and how do you see them improving? I think it's a really good question, because I think measurement is such an important subject. So how do we see the measurement improving? And what are the greatest limitations today on that? Anyone want to jump in? Miriam?
This is one of my favorite topics. So I think it does get a little bit back to where I started, which is where if you align your metrics from a social impact and a business lens, then that solves a great deal of noise on the outside and streamlines things. But of course, that's easier said than done. And I think a lot of times to do a quote unquote proper impact evaluation from a social impact perspective can be, quite burdensome, both in terms of time, effort, reaching your end users, resources required. And so there's definitely room for more partnerships to be able to facilitate those types of evaluations. And we've seen some of those in our portfolio as well as a value add to help companies prove their social impact, which they intuitively have baked into their missions, but don't necessarily have the wherewithal or the resources to extract the data that supports that. The other thing that is really exciting to us is seeing some of these using technology, sort of quick pulse methods of surveying folks and seeing what the impact is in real time on the ground, virtually without going anywhere, just using the simplest of phones to do very, very easy surveys and getting a sense of at least the direction in which some of those impacts are trending. So that's something I think, especially in this COVID virtual environment, that has shifted and that I think and hope will be here to stay.
And we talked earlier about the timing in terms of the underserved proportion of society increasing dramatically because of COVID. We haven't talked about the accelerator, which whatever's the word, that COVID's causing in terms of technology adoption generally. And I think that must play heavily into this space. Anyone got any examples of anything that's sort of come about? I know, post-pandemic, we're a year now, or nearly a year in. Anyone seen any changes or any opportunities that have arisen?
I think so in our portfolio, the digital remittance thing has been just this enormous theme, seeing people go from transferring money sort of live and in person to doing that very quickly and almost entirely digitally during the COVID era. So that's been one thing that we've seen. I did want to sort of comment a little bit on the measurement question, because I think there's a one of the real struggles is, I think, Miriam was describing sort of the nuance and depth at which you could sort of answer that question at the company level and think about sort of how the company is having an impact. One of the big challenges right now is that for investors, almost all of us as investors are investing out of somewhat commingled vehicles. And so we then have this need for sort of metrics that cut across multiple kind of companies. And what you end up having is, I think, descending levels of quality, because it tends to therefore become lowest common denominator metrics. And so I do think there is actually a really difficult tension at the heart of measurement, that good measurement that's thoughtful and deep and rich versus measurement that's widely applicable to a whole bunch of things. And that problem gets worse the more commingled, the larger, the more mixed the strategies and the investors running. And there's been such a historic tendency in the capital markets to encourage sort of diversification and multi-assets and really multi-sectors, that there is this sort of push actually to therefore very general and quite bland metrics. And I do think one of the, it's one of the ways we describe this, right, is in the charitable sector, you would never have a commingled fund that simultaneously was trying to save whales and children and then ask them to sort of measure quality, right? And so there is a bit of an absurdity that we have, all of these commingled vehicles trying to then sort of translate to deep single company impacts.
I think it's really interesting. Something we grapple with at BGV a lot is what are the appropriate measurements? And Camilla, we've over the years had many conversations around measurement of outcomes. Do you want to share some of your thinking here?
Yeah, and I think one of the things that at the sort of broader level that I guess sort of excites us here is that we are starting to see, appreciate there is still a lot of difference in terms of how people talk about their impact and measure it, but we are starting to see some form of almost common languages, common frameworks emerge. And I think that is really exciting. If we're trying to encourage more capital into this space, the more that we can sort of align ourselves, particularly around the SDGs, that's a really, well-known, well-understood sort of metric. In our portfolio, we work with BGV to do this. We use a framework from the Impact Management Project, and that's a really, really nice tool that allows us at the sort of fund and at the underlying venture level to use the same language and articulate, the impact that we're seeking to achieve. Who is that for? What are the mechanisms for doing that? What are the impact risks? And setting that kind of common framework really, I think, will help us. Will help us not only sort of demonstrate impact in a more effective way, but hopefully, therefore, bring other investors into this space and allow us to start making some of those sort of comparisons across different areas where possible. But it is a really challenging area. We're still sort of navigating that ourselves and testing different approaches in the wide sort of range of funds that we manage. But I think getting to common languages, common frameworks, that is a really exciting sort of place to start to get to.
Louise, do you want to pick up on that?
Yeah, I mean, I agree with all of this in terms of the complexity of measuring within a venture and then across a portfolio. I just kind of point on financial health and resilience more generally. It's really hard to measure for an individual, never mind across a whole venture and then across a whole portfolio. It's a really complex thing to assess what someone's financial health is. And it has dimensions including savings, access to credit, social support. So even at the micro level, this is a tricky area to measure impact and outcomes in. So I wouldn't underestimate the issues. It doesn't mean it's not possible, but it's something that's with a lot of nuance to it.
Yeah, I agree, but it's a very important topic. I think sort of beginning, we've got 10 minutes left, so we're beginning to wrap up. I'd welcome some more thoughts from the audience if you have any. But I'm going to ask each of the panelists as a general question, what they'd like to see next. So this is a really exciting space. There's more investment money coming into it. I think there are more entrepreneurs who are looking at starting businesses in the space. But what would you guys like to see happen? And I'm going to be totally democratic and start according to my Zoom screen with Camilla, who's my top left. What would you like to see happen next in the world of FinTech for Good?
Yeah, thank you. I mean, I think addressing some of those gaps that we talked about, particularly on the capital spectrum, agree on the sort of catalytic capital. that missing sort of middle piece for ventures is really important. So
is that real? Sorry to interrupt. The missing. I hear a lot of talk about the missing middle piece. Do you want to, for the sake of jargon, sort of explain it a bit to the audience what you mean by that and
so
why
it's
it's a problem?
That gap between sort of very, very early stage ventures and people sort of relying on friends and families to bridge them to the sort of next stage where they've got, you know, demonstration of product market fit. They're accessing some of those larger scale VC funds. I think it is real. We do see it in some of the portfolios that we invest in. It also touches a bit on the points that we discussed earlier in terms of networks and access to different funds for different types of founders running different types of ventures. I think there is still a really fundamental sort of diversity challenges within the broader sort of venture space. And there's a lot of work, you know, BGB and others are doing to increase, you know, access to that type of capital for founders who are sort of particularly operating within certain networks. So I think, you know, for us, we do sort of see it in some of the funds. We'll be interested to see what the sort of rest of the panel think. But addressing those capital gaps for me is really important. And again, we've talked about it, but whatever we can do to bring some of those different sort of players into the space, to make impact into those ventures in a really intentional way, right through the early stages. I think those would be the two sort of fundamental things for me.
And to be clear, is the capital gap occurring after your investment, do you think? No, so is the next money in after you, or?
Well, so the funds that we've invested in, so across sort of 11 funds, are at different stages of the capital spectrum. So we've invested in sort of early stage accelerators like BGB through to later stage sort of seed and Series A funds. So our money is going in, I guess, at different stages. But I think there is that sort of gap there. You know, the funds that we've invested in, tell us that it's real. But yeah, interested in others' views.
Miriam, do you want to pick up on that, or do you want to, or both? Also,
sure.
say what you want to see happen next.
I agree with that sentiment, and the Catalyst Fund, which I mentioned, was designed specifically to get at that gap for very early stage entrepreneurs. They call it the Valley of Death, where companies who have promising ideas and just not quite enough capital or connections go to die if they don't have the support. Similarly, I think, you know, in the US context, equity is a huge consideration. So we've been talking a lot about, you know, low, moderate income, which is true in different degrees around the world. I think equity is true around the world as well. How that looks depends on market context, of course, but in the US, if you look at the capital that's reaching entrepreneurs of color, and globally, the capital that's reaching women entrepreneurs, it's a drop in the bucket. And there's so much work to be done collectively in solving that gap. And similarly, it comes down to those super early stages where the connectivity and access to networks and capital can make all of the difference. So I think that's something that we're continuing to push on.
Thanks, Miriam. Omid.
So I think the one idea that would be interesting to really sort of explore is how do we sort of embed permanent institutions into these markets and into these communities that can sort of live in perpetuity. Because one of the challenges with sort of funds and everything else is that it's transactional by its nature and you're flipping in and out of things. In the US, we have something called CDFIs, which are community development financial institutions. And to me, there are really, I mean, there's some flaws to them, but the sort of interesting thing about them is that they're permanent. They get capitalized with a certain amount of grants, they borrow money from banks, and then they sort of invest in their local communities, doing the kind of small dollar banking that, you know, we used to see in A Wonderful Life. As sort of the banking system across the world, quite frankly, stopped doing that, embedding these kind of local permanent entities that have sort of a vested interest in building a micro ecosystem, I think is really, really important, because even at the best of times, you know, the venture style businesses are a minority of the needs. And where you have those kind of institutions, you see sort of over generations, lots of sort of sustained wealth building. There's all this interesting like literature from Raj Chetty and others on sort of, you know, place-based determinants of sort of wealth building. And so I think thinking about sort of that a little bit and sort of how do we actually leave something that's permanent in these communities.
I think that sort of local point is really interesting, and I think the pandemic has given rise to a lot of thinking about. I mean, I don't want to get too political here, but central government hasn't always done a brilliant job, and the pressure of, often services and outcomes are better delivered locally. I think that's a message that's being delivered loud and clear, and be interesting to see how that continues to develop when life becomes a bit more normal. Louise, what would you like to see happening next?
Yeah, briefly on CDFIs, they do exist in the UK, but it's a tiny, tiny market, and the legislative and regulatory setup in the US has allowed those to be much bigger, and so credit unions and CDFIs could play a role in the UK, but they need to get much more of them, and Fair for All Finance is looking at some of that. So I would like to see more big institutions getting involved in this agenda, particularly in the UK. I think there is capacity for them to work with innovators to help develop stuff, either as open innovation or partnerships or funding other programs, because ultimately when you need to have a big impact on this stuff, you need to reach scale. And certainly in a market where financial services is so concentrated amongst a lot of large players, getting access to customers and getting trusted access to customers is a really big barrier. So I think we really need financial institutions to be part of the picture here, even if they're not doing it by themselves. I really like to see some better connection in a lot of the cases to the evidence we have around what really makes a difference to people's financial health. There's not loads of it, but there is some behavioural evidence about what's effective and what's not, and really connecting both the lived experience and the evidence that exists to people developing ideas at an early stage can help to get people on the right path, and to make sure that what gets developed is really tackling the right problems and getting at the right issues. And then there's a slightly more subtle issue in that we talked a bit about the ways in which it's easier for fintechs to innovate, the cost structures and the different ways of looking at things that make it easier than operating out of a big institution. But the lot of the challenge in financial well-being, when the basic things are provided already, is engaging customers in the idea of savings or the idea of planning for a future, helping introduce people to behavioral change. So experts on that user front end with experts on the fintech back end coming together could produce some really interesting stuff. We just don't have enough of those connections to see that really happen, I think, at scale yet.
Thanks very much. I have a couple of, so one's more a comment and one's a question, but from the audience. So Fiona Lamb writes, I'm from the UK financial services sector and work with some very large companies. I think your key issue, for what it's worth, is visibility or lack of it. Fintech for good social impact investment is something I'm interested in just now, so I've looked under the hood and I'm impressed, but I'd say generally many of you are not known about, and market visibility needs to be much greater. I would agree with that. I think that's not an easy question not an easy problem to solve, but I think part of it also speaks to a little bit of what Louise was just saying about, if we, as larger organizations come on board, it's not just capital. I think that can give some visibility. And to the next point from Christopher Kemp's about trust, where he says, totally agree with Louise's statement, there's still a big gap in mutual knowledge and understanding between the financial world and that of social organizations on the topic of financial resilience. We should definitely bring them together. Any suggestions how this can be done step by step? Trust seems to be a key element. So a question around, I suppose, broadening the knowledge and understanding on the topic of financial resilience. I think we've covered that quite extensively, but anyone have any final thoughts on that before we sign off?
I would just say that accelerators and all these programs have a big role to play there in bringing those perspectives together.
Great, thanks. Miriam?
Just super quickly, I think there's a translation role that a lot of us on this call have to play. Sometimes it's as simple as using different language or putting things in the perspective of different stakeholders so that they apply to their settings as well.
It's a pet hate of mine, jargon, and we none of us realize when we're doing it, but it totally destroys our message if we use it and don't use the appropriate language. Well, that's a good note to end the subject of language. So I'd like to thank all of my panelists, Camilla, Miriam, Omid and Louise, for a really interesting discussion. Thanks, Paul, for helping to organize it, and Millie from Bethnal Green Ventures. So I think our time is up, the allotted hour is over. So I'd like to say goodbye to everybody and thanks very much for joining us.
Thank you.